2 days to go before the very important US FOMC meeting. Now, why is it important? It's important because it sets interest rates and the direction of the dollar for weeks and months to come. And this is something that has been on our back foot as far as the US has been concerned, despite data showing that inflation has been falling. In fact, 1 year ago, the US itself said that they had triggered the Shom rule and were actually, which is related to unemployment, and they were actually looking at cutting rates, and they did once. And then they completely paused, and that set off the thought process that maybe they're going to keep rates higher for longer. Maybe they're not confident of where inflation is headed. But the data has been showing that inflation rates come down over this entire period of time, especially if one of the biggest components of inflation, which is oil, was actually held down due to the policies of the US government. Specifically, whatever Donald Trump has done since his presidency has been to get enough oil production back on the market, and now all his talks, to get Russia and Ukraine to be on the same page, or whether it's in the Iran and Israel talks, is essentially keep oil supply flowing, and what that does is keeps oil prices down, and therefore as economic activity picks up, unless things really go out of control, we are not really looking at high rates of inflation immediately. You'll need the entire commodity cycle to completely take off for that to happen, and that creates a very good environment not just for the US to cut rates, but also the rest of the world. And this is the key, right? So far, what was happening till last year is, other markets or other economies, specifically, Europe, were cutting interest rates. Japan tried a few times and then they gave up because the inflation data remains higher. And their bond yields are actually not responding. So despite rate cuts, bond yields in Japan are going higher. In the US, bond yields are sort of flattish. They're waiting for direction. They're not really going up or down. And if you study the positioning, that is the US CFTC data, you'll find that you are near record short still in the bond market. But some of it has recently started to get covered. So some of the shorts are actually going off the US bond market, and that's indicating what I think is going to be a bond market rally as far as the US has been concerned. But I've been saying that for a year. We've seen a couple of attempts for bonds to go up or yields to go down. Each of them have not gone very far. I wouldn't say it's a complete failure because it's been mostly range bound. So that means yields have come off a bit, but then gone up again, and it's been in that particular range. But the setup is for it to eventually fall. That is, bond yields fall and you get a decent bond market rally. Now that doesn't mean you're going back to the negative interest rates or 1% interest rate yields that you used to have up until COVID, right? COVID is the low point as far as the US bond market is concerned, or yields are concerned, and the peak in the US bond market. So you're not going back there, but you can definitely get a 38 or 50% retracement of the entire fall we've seen in the US bond market, and that is what I call as a decent bond market rally. And that would be very good for bond yields around the world, and it would be taking away pressure from the dollar significantly. The dollar has actually been falling for quite a while now. It attempted to go back up sometime last year and then started to fall again. And now this renewed decline in the dollar that we've been seeing since the start of 2025 is looking like becoming a trend. Recently, it did try to bounce back, but once again failed at the 20-week average. Now, this is very important because all these components are what lead us to the market view as far as India is concerned. India's been in a tough spot because it has not been correlating with the rest of the world, right? The rest of the world has been easing liquidity and allowing their markets to take off. There have been tariffs on other parts of the world, but they've sort of negotiated something better than at least what India got. And that remains a pain point, and due to which we've probably taken a hit in some of the stocks and sectors. But because our domestic economy is strong and because we have a lot of domestic liquidity, we've managed to hold our own. So we haven't crashed outright except in maybe particular stocks or sectors. But overall, the market has actually held out stronger. Pockets of growth have allowed even mid and small caps to outperform the large caps. And a lot of the themes remain the same, whether it's defense or whether it's PSU banks, all of these are getting action all over again. So the main point being that the Indian stock market seems to have bottomed out in April with the rest of the world. It's not participating on the upside for the time being, but now what you're seeing over the last 2 weeks is a pickup from a very, very important support level, and now we are bang at the first key resistance, which is typically 61% of the last decline that we've seen since July. That level is 25,162, and I think once the markets get past that is when the next round of action really shows up. That's where confidence will return significantly to a lot of traders and investors' mindsets that yes, this is a market that's ready to head up to new highs. I think there is a serious case for that to happen, which is why I wrote the long short report last weekend, and it's already published. So if you want to read the detailed analysis, wave counts, alternate structures, and what else can happen to the Indian market and what are we really thinking longer term, then you do go out and read the long short report, which I write once in a month or two, as and when the time is appropriate. We try to put it out, but at least bi-monthly there is one report to keep us in continuity of what is really going on. And it also focuses a lot on the big picture, because in the short term sometimes we can get caught by near-term events, news-based moves, etc. But the structure does tell us a lot about how markets may pave their way into the future. And the structure is essentially very, very interesting, because markets have pulled back and taken support at key levels, and the retracement has not been deep. I was trying to do a comparison with what happened in 2021-22, where the pullback into June of 2022 almost retraced more than 50% of the gains that we made from the panic lows of that year. So when you see that kind of a move, where you get a significant retracement, and I think not June. So June is where it started. So to put it more correctly, from June to December, you got a bounce back, and then you pulled back into March of 23, right? And that was a more than 50% retracement. Now things are happening much, much faster this year. This is something I discussed in Weekend with Indiacharts, our weekly review, video review that I do of markets every weekend. And I discussed this a couple of weeks ago, that things are happening much faster in terms of time this year. So whatever happened in 21-22 till say June is probably already happened in April. We already did the bounce back, and now when we are falling, we are retraced less than 50%. This time it's like barely 38%, and then we have taken support there. So it's showing a lot more resilience apparently, despite more bad news, and happening much faster. So in that sense, we've started the next move higher, which is attempt the highs again, which is what the markets did back then as well. After pulling back into I think it was September of 22, it actually rallied back to a higher high or a new all-time high in December of 23, before doing the final pullback. This time around looks like maybe we've already been through a lot of that, and we are attempting a new move altogether with a smaller retracement. So it's very interesting, while you find similarities, there's also a lot of variation. And when I look across the board, when I see stocks performing better than the index, then I say, well, if it's good for your portfolio, then should you be too focused on the index? Unless you're really trading the index, yes, there you can get it wrong. But the portfolio is hard to get wrong, because there are a lot of stocks performing, and if you have a process or a methodology to pick the right performing stocks, then overall your portfolio is doing well. The market is not down that much, and therefore there is no real reason to really be too worried from an investment point of view, when you have a 1 year, 2 year, 3 year kind of time horizon. So this is what the market has really done to us. We are too focused on short-term news, events, what will be the impact of tariffs, the weakening currency. But what we have seen in the last several years is that many of these events are easily absorbed. I mean, a weak currency is not seen as a very, very big issue. In fact, even in 2013, the market did fall when the rupee fell all the way to 69 and we were panicking. But the decline in the market was actually not that hard when you look at it backwards, because we've seen bigger declines in markets in smaller sell-offs in the rupee. And this time around, when you had one of the biggest declines, you didn't see such a big move in equities on the downside, though you did see a downside move. So over that, and after 2013, the volatility in the currency market has shrunk even more. Now, some of the volatility is coming back, which is a good thing from a trade perspective. But the impact on equities remains similar, that, even though you saw the rupee fall to 83, 84, you're not exactly seeing Nifty going back to 22,000 or 21,000. And so that's a big differentiator for us, because it actually tells you that things are much well managed, and the markets are far more resilient despite the macro risks that we face due to the tariffs, right? Because it does directly hit your current account deficit, which directly affects your currency. Now, the hope, I think the other reason for this is that we've always been hopeful, and hope is that we will resolve these issues through talks. And even though Donald Trump was in denial that talks would help, because he feels that India has been supportive of Russia, he did come out and say that, well, talks are going on. He said that in between last week, and that brought some hope back. But I think with so much back and forth, what the markets really want is clarity. So that is why, even though you're seeing the Indian stock market pick up, and I think it looks like a positive trend, we are not seeing super enthusiasm, because while it is going up, it's like, okay, we got this, but we'd rather wait for the dust to settle and to get complete clarity on what the tariff policy is really going to look like. I think we'll get an idea of that in the coming weeks. I don't know how the Russian imbroglio will really solve itself, but I do hope that India's situation with the US would improve much before all that happens. And if it happens simultaneously, then it's a double win, right? If you actually manage to get Russia and Ukraine to agree to something, wow, that would be the wow moment. So let's see if that wow moment really happens. And in the meantime, what we are seeing is, even if you just avoid the sectors that are likely most affected by the US policy, a lot of domestic sectors are showing momentum again. The correction seems to be complete in a lot of the financials, a lot of the other stocks, whether it's PSUs, PSU banks, power, etc. All the themes are coming back. Mid and small caps also have seen their correction. The stocks that are not able to show growth consistent with their valuations have taken a big hit, and the ones that are able to do so are continuing to move to new highs, irrespective of what the Nifty is doing. So these are very important and interesting trends to keep in account. And all the measures that the government is taking, along with the potential that interest rates in India can go down even further from here, now that the US is moving towards lower rates, creates a very, very good macro environment for equities over the next quarter. So at least that much let's keep in mind, and we can always review it at the end of the year, at what is really going on. And with that in mind, I'm going to be in Goa this year. This is our third time out of our several events. We've done it in Lonavala. We've been to Jaipur last year, but we are going back to Goa. Given that it's been a nice place, I think out of all the places we've done our events, that was one that really stood out strongly. Though repeating a destination can sometimes make you feel that, okay, you're going to the same place, but you know what, meeting up with all these wonderful people who join our mentorship program every year and revisiting the ideas and learning from their experiences and being able to give constructive feedback is a very, very important part of the entire process. So we spend 5 days and 6 nights every year doing this, along with people who've joined our program and completed the entire 3 months of sessions. They get to get a completely new outlook, meet us, and complete their learning. And wherever they have doubts, they're able to clear that. Whereas those who've been visiting us year after year get new insights based on where the market is positioned. And this year I'm going to do a special full day on how do you pick multi-baggers longer term using the combination of wave analysis and data, which is available on Strike on the fundamental side, right? You're actually looking at balance sheet data, you're looking at Elliott wave structures long term, and can you really identify with a process momentum investments and long term baggers that are actually in process. Why this entire debate about valuation with growth gets answered when you actually take the discussion to charts, and that's what I think we'll spend time learning. through my experience with that model. So I have sort of built a process of being able to do that. I'm going to share that, and then we are going to get everybody to constructively act upon it and come up with ideas, and that is how the learning is going to transpire. So there's a full day dedicated to that, and a lot of the things that we really do and enjoy in terms of the interaction and the activities that help people learn things like position sizing, trade management, become very, very important. So looking forward to the next 5 days, 6 nights at Goa starting Wednesday, that we are going to be all there and having fun. So you'll get a lot of the updates that we do from there. Me and my entire team is going to try and pick up things and share it with you so that you get a real feel of what goes on there. And of course, I'm saying all this so that many of you who are looking at pushing up their game to the next level will take interest in joining us and becoming part of the ever-growing community of the Indiacharts inner circle. All the people who've really completed our mentorship program and stay the entire lifetime with us once they are there. That's the goal, that you never leave and you're part of it, and we meet up every time and share and grow together in terms of our knowledge. So looking forward to that, and see you all there. Thank you.